Welcome back to the Deep Dive. Today we're taking a close look at Core Natural Resources, Inc., CNR, after their Q3 2025 earnings call. That was just a few days back, November 6th.
And you really felt the market's reaction almost immediately. I mean, the stock jumped double digits intraday. So our job here really is to cut through some of that short-term noise, the operational challenges, and find the signal. What got the buy side so excited about specifically the path forward into 2026?
Exactly. It's all about separating those temporary headwinds from what look like some serious long-term catalysts. So let's maybe start with the result snapshot. It's kind of a classic case, isn't it? A technical miss on one line, but a fundamental beat elsewhere.
Yeah, you absolutely have to lead with the EPS number. It was, well, dramatic. CNR reported GAAP EPS of $0.61. Now, keep in mind the consensus estimate. That was looking for a loss of $1.40 per share.
Whoa. So like a $2 beat versus expectation.
Precisely. A massive operational surprise. And that points directly towards, really strong internal cost control.
Okay, but then there's the other side. Should we worry that revenue was a bit soft? They reported just over $2.5 million. That missed the street by about 3.9%.
It did miss, but you have to see the context, right? That revenue figure still represents 74% growth compared to last year. Huge growth.
Right. And the market seemed to just shrug off that revenue miss.
It really did. And I think the reason is pretty clear. The cash flow generation showed fantastic resilience. They pulled in $38.9 million in free cash flow, FCF, and almost $87.9 million in cash flow from operations.
And in a situation where a company is facing known operational drags, that ability to still generate free cash, that's probably the best indicator of how well management is steering the ship.
Absolutely. And their overall liquidity position looks really solid, too. Almost $1 billion, $995.4 million.
It was interesting, too, how they handled the costs around the Lear South incident in the adjusted EBITDA number. They reported $141.2 million, but that figure included, $18.4 million in costs from the fire and the mine being idle?
Yeah, and that drag was almost perfectly offset by an initial insurance recovery payment of $19.4 million they received in the quarter.
So that accounting tells a story in itself.
It really does. It shows they're managing these known, hopefully non-recurring issues like the fire pretty effectively. The market isn't just looking at the headline EBITDA. It's seeing how management is controlling the fallout from that crisis, which actually leads us right into the execution details.
Good transition. Let's maybe start with capital allocation, because that story seems very clearly aimed at pleasing shareholders. Management basically reaffirmed their framework, targeting returning about 75% of free cash flow.
And the primary mechanism for that return is share buybacks, though they did also declare the regular sustaining dividend, $0.10 this quarter. And they backed it up with action spent $19.4 million buying back stock in Q3.
How many shares was that?
271,000 shares at an average price around $71.77. So that focus on harvesting FCF and returning it, that sends a powerful signal, especially when the market might be a bit skeptical.
Okay, now let's tackle the biggest operational headache from Q3. Lear South. This is their key high-margin met coal mine, and getting that longwall restarted is delayed. But the reason for the delay is critical here.
Absolutely critical. It's held up because of the government shutdown. That meant the Mine Safety and Health Administration, MSHA personnel weren't available. You need them to sign off on the reentry protocols.
So it's an external regulatory bottleneck, not an issue with the equipment itself or their plan to restart.
That's exactly what management conveyed. They seem very confident the equipment is fundamentally okay, and they still expect that mine to be back up and running before the end of Q4. It just hinges on MSHA getting back on site.
And how are they managing the financial impact? Because those costs must be adding up.
They are. They expect the total costs from the fire and the idling to get close to $100 million by year end. But, and this is a big but, management also explicitly guided that the total insurance recovery, covering both property damage and business interruption, should be in 3 digits.
Meaning north of $100 million.
That's the implication, that they expect to fully cover, maybe even get more back than the total costs incurred, which again shows strong crisis management, protecting the balance sheet and future cash flow from what could have been a much bigger hit.
Okay, let's shift gears to the segment cost performance, because this reveals some of the operational trade-offs they seem to be making with an eye towards 2026. High CV thermal costs looked a bit high, $40.53 per ton. What drove that?
Yeah, That number was elevated, but it seems like it was sort of a necessary investment. It stemmed from temporary challenges at the West Elk mine. They're transitioning mining into a thicker B seam, which involves dealing with more methane up front and also some dewatering.
So near-term pain for long-term gain.
That appears to be the strategy. These aren't necessarily ongoing structural cost issues. They're taking the steps needed to access that thicker seam, which should, in theory, lead to much better productivity and lower unit costs once they're fully up and running in it in 2026.
Makes sense. So they accept higher costs now to set up a more efficient operation later. Meanwhile, how did the Powder River Basin segment, the PRB, perform on costs?
PRB looked really strong, actually. Very solid cost control. Cash cost per ton came in at $13.04, and they realized $14.99 per ton in revenue. So still making margin there.
And wasn't there a benefit from lower royalties?
Yes, exactly. They benefited from a federal coal royalty rate reduction, and importantly, they seem to be passing that saving along to their customers. That helps maintain their competitive footing in the PRB.
And even with Lear South being down for a good chunk of the quarter, the overall metallurgical segment still managed to be cash positive.
That's right. Met segment cash costs were $94.18 per ton against realized revenue of $101.60. So even with that major mine offline, they kept the segment in the black on a cash cost basis, maintaining margin discipline.
And this operational grit, combined with the forward-looking moves, I think this is where we really pivot to the 2026 story the market keyed in on.
Absolutely. The market seems willing to look past the temporary issues in Q3 and Q4 because the commercial team is already locking in future business at a pretty impressive rate.
Yeah, they secured something like 26 million tons of future sales contracts just in Q3 alone. That shows real commercial strength.
It does, and their committed volume position for 2026 is already looking quite robust. They're sitting on about 17 million tons contracted for high CV thermal and over 40 million tons for PRB coal for 2026 delivery. That provides the kind of revenue visibility investors really value.
And underpinning this commercial success are some powerful macro trends, right? Specifically around U.S. power demand.
Definitely. We've seen domestic coal-fired power generation up, around 12% year to date. And this doesn't feel like just a short-term weather blip. It feels more structural.
And the big driver everyone's talking about now is the data center and AI boom. I saw an estimate that U.S. data center power demand could nearly triple by 2030. That's staggering.
Yeah.
Utilities need reliable, baseload power.
Staggering is the right word. And think about the options for utilities needing power now. New natural gas plants face long delays permitting, pipelines, equipment backlogs. So when they're staring down this kind of explosive demand growth from AI and data centers, they need immediate, reliable capacity.
And that points back to existing coal assets.
It points back to well-run, strategically located coal assets. CNR's Pennsylvania mining complex, for example, is right near major eastern load centers. That proximity advantage, combined with the urgent need for power, means utilities are looking to lock in longer-term thermal coal contracts. It basically turns these legacy assets into critical infrastructure again.
Which gives CNR a lot more leverage in contract negotiations. Okay, but there was another major potential catalyst they highlighted, this whole strategic optionality piece around rare earth elements.
Yes, this was fascinating. They announced they've verified elevated ash basis concentration of rare earth elements, REEs, and also critical minerals, CMs, at several key sites, Black Thunder, Coal Creek, and also their eastern operations.
This could be a game changer for valuation if it pans out.
Potentially, yes. And the strategy makes a lot of sense. They want to leverage the immense scale of their existing permitted mining operations. Think about it. They already move enormous amounts of earth.
Yeah.
They have the permits, the infrastructure, the logistics. They don't need to build a brand new multi-billion-dollar REE mine from scratch.
So they're looking at these critical minerals almost like a byproduct or a co-product stream from their main coal business.
That seems to be the angle. They mentioned they're moving into expanded drilling now to better understand the resource, and they're evaluating potential partners and putting out RFPs for extraction technology. And it's still an if, but if they can figure out a cost-effective way to extract these REEs and CMs,
it completely changes the story.
It totally transforms the narrative. CNR goes from being seen as just a cyclical coal producer to potentially a vertically integrated strategic materials supplier. That's a profile that none of their traditional thermal or met coal peers can match.
Okay, let's quickly cover the guidance updates before we move to the trade idea. They lowered 2025 CapEx.
Yes, smartly trimmed it by $40 million. The new range is $260 million to $290 million for the year. Lower spending generally means, more potential for free cash flow.
And the merger synergies. Still on track.
Still targeting that $150 million to $170 million range. They said they're about halfway there, roughly 50% achieved, and they expect to hit the full annualized run rate of those savings sometime in Q2 2026. So you have this convergence, lower capex, synergies kicking in, Lear South restarting, strong demand. It sets up a potentially very strong 2026.
Okay, which brings us to our This Is Not Financial Advice segment. All right, so you look at CNR stock this year, it's really lagged, down over 16% year to date. Meanwhile, you look at something like the XME Materials Index, their peers are up massively, 38%, maybe even over 60% in some cases. The market seems to be pricing CNR as if these 2025 operational issues are permanent fixtures.
Yeah, the discount versus peers is pretty stark, and it feels like the market has basically assigned zero value to the optionality we just talked about.
So here's the outrageous but plausible trade idea. Thinking about long-dated, deep-in-the-money call options on CNR. The bet is essentially on a sustained re-rating of the stock's multiple heading into 2026.
And the thesis rests entirely on that optionality stack coming into view. First, you get the successful restart of Lear South that brings high-margin met coal volumes back online, boosting cash flow pretty immediately.
And then, layered on top of that, is the market starting to believe in a credible commercial path for those REE and critical mineral byproduct streams, if that happens.
If that happens, the whole perception shifts. It's not just a coal company anymore, it's a strategic materials play. And that kind of business deserves a higher, maybe more industrial type multiple than a pure cyclical commodity producer. That potential multiple expansion isn't reflected in today's price at all. It's a bet on both operational recovery and strategic diversification proving out.
Okay, so that wraps up our deep dive on core natural resources. I think the key takeaways from that Q3 call are pretty clear. Definite operational resilience despite the headwinds, a very strong commitment to returning free cash flow to shareholders, and there's a really compelling strategic optionality.
Yeah, both the near-term optionality from getting Lear South back online and then that potentially massive long-term value unlock from the rare earth elements.
And thinking about the bigger picture, we've talked about that explosive growth forecast for data center power needs. It's really reshaping the energy map almost in real time. So the provocative thought maybe to leave you with is this. How quickly might utilities feel forced to actually underwrite major capacity expansions or maybe life extensions at some of these legacy thermal coal plants? And what could that mean for CNR's contract visibility and pricing power in 2027 and beyond, even past the volumes they've already locked in for 2026?
Definitely something to think about. Where does that long-term demand find a home?
Food for thought. As always, please remember to do your own research and due diligence on any companies or concepts we discuss here.
Thanks for joining us on the Deep Dive.